Welcome to Nasdaq Trade Talks. I'm your host, Jill Malantrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Luke Rabari. He's the CEO of Equity Armor Investments, and we're going to discuss how U.S. equities remain the investor's choice. Luke, it's great to have you back with me, as always. And before we get into that comparison there, Wednesday is a big day. Everyone looking forward to what's finally going to happen with the Fed.
Huge day, but I mean, it's not anything new. Everyone is looking for it because they're looking to invest in the market depending on what the Fed says. And I know you can't fight the Fed rather than fundamentals, right? Because remember a few months ago when the Fed was saying, or when they didn't cut rates, right? Everyone's, oh no, the Fed's out, and the market went down. I mean, it should be trading on fundamentals, but that's what everyone's waiting for. And obviously, as you know, I disagree that they should cut, but we'll take a look.
I mean, we're in the thick of earnings season right now, and of course, second quarter earnings, it's so condensed because it's over the summer. You have 3-4 weeks of hundreds of companies reporting each week. I would argue earnings beats have not been that spectacular. And again, no one's even looking at the fundamentals. They're just focused on what's happening with central bank and trade tariffs here.
Yeah, I mean, it's stopped being a stock market, and it's just a few stocks driving the market, and it's the Fed. And I don't think that makes for a good recipe. I mean, we were talking earlier off camera, how many of the companies in the S&P 500 do you know that have actually taken the money they got overseas and invested in new plants, hired people? And how much of that money has been used for financial engineering, i.e. stock buybacks, mergers, or some other thing that doesn't have to do with expansion of the business? I think that's a real problem, and it's going to catch up to us.
And I would say single digits in terms of investing in the company, into R&D. Let's take a look at our first chart here. This is S&P versus the Nasdaq Composite, gold and Chinese stocks. And again, you could see the orange and the white line there, U.S. equities.
Yeah, I mean, it's hard. Look, we're going back to 2014 here, right? It's hard to take a look at this chart and say this market needs a rate cut, right? I mean, look at the S&P, look at the Nasdaq, right? Capital is flowing to parts of the market where it shouldn't, right? People are taking too much risk, and this is what you're seeing. With this type of market, the Fed should be trying to get ahead of it. Maybe it's okay to cool off the market a little bit, because when something does happen, you want to have some bullets left. But I don't know what they're going to do. I mean, negative rates, that's our next thing, right? And if you look at, I'm showing China right now, but maybe the next time we talk, I'll show Japan. The Bank of Japan is now holding ETFs and stocks. That's crazy. That's like the central bank saying, I'm going to buy GM and Google.
And then you wonder why yields are so low and why they want to continue to cut rates some more. Let's take a look at our next chart again, the S&P 500 versus 3-month yields here.
So let's take a look. I think everybody knows what this is about, right?
Of course, equity market.
Right. But this is when the Fed, when they thought the Fed is going to be, this is not how the market should be acting. Right? I mean, yeah, there's a little bit of a blip because maybe money's not as easier, but do the fundamentals really call for that? And what I'm worried about is when the market stops believing the Fed, or when the Fed can no longer move markets the way it used to. Take a look at this. Right? How many points are we going to go straight down because everyone's going to head for the exits in the same stocks at the same time?
Exactly.
Right.
And then where do you go from there is the next question as well.
Right. So for us right now, we're starting to say that you've got to own companies, and some of them are the big flyers, but that have a huge cash position that pay dividends, right? Because right now you don't want to be in fixed income. I know I certainly don't. And as long as the Fed is going to keep doing the wrong thing, in my opinion, I certainly can't fight the Fed. So what we want to be in is companies that pay dividends. Right? They have a big cash position. They're not buying back stock. They're giving it back to the shareholders. They pay those dividends, and that's where you want to be. And then when a big drop does happen, those stocks will go down, but at least you'll have some of the dividend, and they have a stronger cash position to withstand the market. But this is, this is all from what you think the Fed is or isn't going to do. That's not a market on fundamentals.
Right. Well, I mean, even the move on the downside and also the upside, it just fundamentally makes no sense. The question that we're getting in the mainstream now, though, is if you are getting negative yields, why would you put your money into that bank, into that institution? What's the upside for the investor?
A lot of it there's a few different things. One, it has to do with the rules that a pension or an endowment might have of a certain percentage of their assets that have to be in AAA rated fixed income, right? So they can't escape from that. Just like pensions have that a certain percentage of their assets have to be in the S&P, et cetera. So the money continues to stay there because sovereigns are triple rated, right? AAA rated, and they have to, and people think that they're buying negative yields, but no, that's where they really have to be. Secondly, if you're a real pessimist and you think the market's going to go down 15%, maybe you don't mind buying sovereigns and saying, all right, I'm going to lose a quarter of a basis points on $100 billion, but if I had it in the market, that could go down to $70 billion, or it could go down to $80 billion. So that's another reason. But don't get fooled that people are loving negative rates, or you just need to have AAAs. It's the investment procedures that they have, and that's part of the reason they continue to be invested in those things.
All right, the conversation should be interesting when you're back here in August. Thanks so much, as always, for joining me. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.